Good afternoon and welcome everyone to today's US market update and first quarter 2020 earnings review. Great to see so many on today's webcast. My name is Kelly Main, Associate Portfolio Manager, and with me today are Fortran CEO Joe Forster, along with Portfolio Managers Chris Wallerman, Stephen Lyle, and Andrew Corcoran. Before we get started, I'll just read the necessary disclosures.
You don't need to. Just do.
Okay. With that, I'll now turn the presentation over to Joe.
So good morning. You should be able to ask questions by putting your hand up. Kelly, I think somebody's put their hand up. You want to just check that we have a question? So please ask questions along. I see two participants raised hands. So Kelly's going to monitor that and see if you have questions along the way. So to start with, instead of getting the normal catering of the Costco sandwiches, we decided to do catering from Vue de Monde today. And so hopefully that'll encourage you to come along next month. That was sense of humor. The market, of course, is up 11.5%, while earnings estimates were cut 9.4% for the year ending December 2021. That's pushing the price-earnings ratio for 2021 up 23% to 17.3. So we're trading at a much higher multiple than ever before. Since 2000 in 2000 when we had the dot-com bubble. Earnings estimates are just starting to be cut, and the 100 companies have pulled guidance or dividends so far. So we're getting earnings estimates which have a very wide range in expectations because there's very little guidance and there's so much uncertainty. Now, is that a question, Kelly? Okay. So we're figuring out how to answer questions here, so we hope you keep putting them through if we're missing them. In February, we said that 5 companies were making up 18% of the S&P 500. There's been a continued consolidation of the leadership in the market as people are snacking and clicking. And so Apple, Microsoft, Alphabet, Amazon, and Facebook were 18% of the S&P 500 and now represent 20.5% with further consolidation in that leadership. Clicks and snacks are companies like Mondelez, where people are staying home and eating crackers and cheese, and they are clicking on their computers, which is benefiting those companies that allow for virtualization, whereas other industries are collapsing, such as oil, auto, transportation, real estate, and retail. We're going to see a number of bankruptcies of retailers to follow on from J. Crew. We could have a bankruptcy from Macy's and many other companies as people use Amazon to buy things. Auto, of course, people aren't driving. Airlines, people aren't flying. And in real estate, we'll see later that people in office space in New York City are not paying rent. I think they collected about 75% of rents in April, but the retailers have only collected about 50%. So we expect to see a lot of bankruptcies in real estate as well. What's going on in the market is what I call a head fake right now. So with quantitative easing, the Federal Reserve Bank is buying bonds from banks, and they're pushing down into the risk curve by buying bonds issued at just above the junk rating, which means that the Federal Reserve has substantially changed their policy in the market of avoiding risk to actually taking on risk. And as they buy bonds in the market, we're seeing a lot of improvement in the trading desks of Goldman Sachs and Morgan Stanley, Bank of America, et cetera. So we're seeing some very strong liquidity being driven into Wall Street, but that is not really helping Main Street. It's the fiscal policy from the Treasury, where the Treasury, of course, will tax and spend money and has substantial debt already, where they will need to get money into the hands of consumers quickly so that consumers will not go bankrupt. For example, the U.S. GDP is around 20 trillion. The U.S. Treasury debt is about 22. And perversely now, the Federal Reserve is actually at the point where they're almost paying the federal government to borrow money, which is not somewhere that we want to have for very long. Because if the federal government is encouraged to borrow money, it could encourage them to get further into debt. So it's not helping Main Street. So there's some concerns there. Kelly, I can't see the last point there. So what we're seeing is a destruction of capital base, particularly in the middle class. So if we have 30 million people now unemployed out of a workforce of about 165 million, that's about 18% of the workforce is suddenly unemployed, and they will get some benefits from the Treasury, but they are seeing massive destruction capital, particularly in that middle class, young families, for the sake of what we're recommending right now is preserve capital as we head into this. And we think the market's run up this month was what we call a head fake. So if you don't know what a head fake is, if you're playing sports and you fake you're going this way, you're going that way. It's a misleading direction by the market. The biggest mover, the recovery, we did have this deep fall off in the beginning and then a bounce back this month. And the deepest fall off was for oil, for restaurants, for home builders, and those in the raw material end of the market. So you can see here, big bounce back from very low base for Brinker, the food company, Devon and Marathon, which have shale prospects in the Permian Basin, for example. These companies are purely speculative investments at this stage, and we'd be avoiding them. Wendy's has done well. Interesting, Chipotle is actually doing very well out of this crisis. Chipotle, the burrito company, is benefiting from their online ordering system where people are walking up to get the burrito and walk away. So their takeaway business is doing very well. I got takeaway from Chin Chin the other day, and they're doing extremely well. So some restaurants are doing well, but many are not. Specifically, companies like Brinker and Darden, who have restaurants where you go in, you sit down, and you get that table service. So that Brinker Darden end of the market is in deep trouble because they have so much more invested in their real estate and their infrastructure. Whereas a company like Chipotle, where they line up to get the burrito, is benefiting. Whirlpool announced actually pretty good earnings. Interestingly, demand hasn't fallen off yet, but the raw material prices have. So we'll get into that in more detail. But on the negative side of the market, we're continuing to see intense pressure on the airlines, Delta, United, Southwest. Boeing is in deep trouble because of their problem with the MAX plane and that being grounded for a while. But we've also seen some very conservative, concerning results out of Airbus. And that's impacting General Electric, that makes the engines for the aerospace industry. So on the negative side, it's a real mix of what's going on in the market right now. It's what we would think of as potentially a dead cat bounce, which is causing the scattering. Now, as we get in the relative value model and how we interpret things, we're seeing on this raw material end of the market this big run up in metals, oils, chemicals, paper and forest products, and some weakness down in financials. But you can see in the earnings estimates cuts, the biggest earnings estimates cuts are coming straight out of oil. And of course, oil is being used to make jet fuel, diesel, petrol, and the fall off in demand for these is severe. So I would say that the real economic indicator is not the stock market, which is being driven by liquidity, but oil, which is granted more volatile than the economy itself, is really a better indicator of what's going on in the economy. So I would say that oil is an indicator of economic activity. And I'd be very cautious as you see oil companies forecasting losses out to 2 years out, where we could see a number of bankruptcies. So we'll talk a little bit more about oil companies later. In the relative value model graphs, of course, do we have any questions? Because anyone putting up their hand? Am I speaking too fast for people? Can I get some? I'm used to having an audience here where I can see people in the eye and where I can. No questions. Can someone ask a question? No. Okay. Okay. Well, I describe the relative value model graphs as looking more like a butterfly than a caterpillar. And what that means is that the range in earnings estimates has increased. And so along that regression line, which goes from 0 to the top right, which is the average PE ratio, what we're seeing is a bigger spread off of that line and more of a blot than a line of similar PEs. In other words, the R2 or the regression analysis shows a further distribution from the mean. And as we get down into different sectors and we look at consumer products, for example, we'll see a wider range of price earnings ratios and more of a butterfly looking pattern than we do a caterpillar pattern in the graphs, which usually represents opportunity. From a macro point of view, I hope that we've been guiding clients, we've tried very hard to guide clients over a long period of time to expect shock events. We've talked about what we call bubble cycles, which are being driven by the amount of debt issued in the US and how the US runs a trade deficit. Of course, when the US runs a trade deficit, the US exports dollars to petro countries and to China, and then petro countries in China have to use those US dollars to buy US assets. And as a result of that, there's this constant flow of money. As the US runs a trade deficit, there's a constant flow of money back into the US to buy assets. We'd say in the 90s that recycled into dot-com stocks. And then in the early 2000s, we saw a flow into real estate. And then more recently, in the last 10 years, we've seen a flow into US treasuries because it's not politically acceptable for China to buy assets that they can control. So they're better to buy treasuries and exchange traded funds where they're not seen as owning a marquee building such as the Waldorf Astoria, where the president likes to stay. So of course the president doesn't stay at the Waldorf anymore because the Chinese own it. So these types of political pressures cause the foreign money coming back in to be invested into treasuries and a broad exchange traded fund where they're less visible in owning things, but they own a lot of US assets. So these bubble cycles and this debt, we say, puts the US on margin. And I hope that we've coached you in expecting a shock event. The VIX represents the premiums in the option market. Of course, we saw the VIX surge to about 80 during the global financial crisis and then to 40 during European debt crisis 1 and European debt crisis 2. And we've seen another surge in the VIX, which is a reflection of risk in the stock market. But what we do is look at the standard deviation around earnings estimates. So if you have a company like Clorox with a bell curve, which is very steep and narrow, those earnings are predictable and it deserves a higher price earnings ratio. But when you're looking at Whirlpool or Ford, you have more economic influences affecting the earnings estimates, and you have a flatter, wider bell curve and less predictable earnings, which would dictate a lower price earnings ratio because there's more risk in those earnings. Kelly, how am I going for none? I don't have to watch. It's only 14 minutes into it, and we're not getting a whole lot of questions. Can I pause and see if we can get any questions? People are more likely to ask questions if you're here. Hopefully we'll have
Joe, I think maybe some comments around the currency right now, particularly the AUD relative to the USD.
Well, why don't you comment on that one? I think you're key for that.
Right. So what we found over time is the biggest determinant in the exchange rate between the USD and the Aussie dollar, for instance, is the differential in interest rate policies across the countries. And what we had seen prior to, well, really the last month and a half, was a tightening of credit in the US and an interest rate policy that was trending up, and a more neutral policy in Australia. Now, however, that has shifted. Australia has been a bit more, I think, conservative in their interest rate cuts versus what the Fed has done, which has taken aggressive action, not only from an interest rate policy standpoint, but also extraordinary monetary initiatives to try and support the economy and liquidity. But with that said, the US dollar has strengthened considerably. Now, we've seen in the last week, really, the Australian dollar recover from about 55 cents to 65, quite a move. And it seems, in our view, may be temporary, because the pain in Australia will probably be suffered longer than the U.S. Or other words, the recovery in the U.S. will be sooner than here because of the Chinese exposure to the Australian economy.
Yeah, well, with that said, thanks, Steve. With that said, I would also suggest that the U.S. has more ability to bail out citizens because of the debt levels than the U.S. does. And in Europe in particular, the debt levels are so high that I don't think they can afford to bail out. They're just going to have to shift to a herd immunity policy there, which is, of course, where you let the virus spread. And that's the way measles worked, or chickenpox, or viruses worked for many, many centuries. And we believe quite strongly that the government's overreacting with these lockdowns, and that there should be, Trump's got a tough decision to make, and I don't see it as tough as many people do. I might be cold-hearted about this, but I think that the lockdowns are doing a lot more damage than the virus would if it was left to its own. We do have, so butterflies and caterpillars, we said that. The relative value model is fundamentally a supply chain analysis. We start with raw materials, and we look at how raw materials prices changes are going to impact manufacturing, and then consumer non-cyclicals, consumer cyclicals, and working down through technology and financials. So it's a very interesting analysis right now, because what we can see is the push-pull in different sectors, and how one sector is being flexible or not. How quickly are these companies able to adapt? And that goes into our analysis of what we call the velocity of creative destruction. So the velocity of creative destruction is a very important concept. And I refer you back to the report we did 18 months ago, Andrew? Roughly 18 months ago, on the velocity of creative destruction and which industries have a better ability to adapt. Because it's a very key thing right now. And the question becomes, is the velocity of destruction greater than the potential to recreate? So sometimes the velocity of creative destruction is seen as a good thing, because it allows for failure for new companies to emerge in their place. But if that velocity is so fast that it destroys capital, then it can be a net negative. So it's interesting to look how different companies are flexible. In January, we started to see manufacturing companies adjust their supply chains and moving purchasing out of China and into Vietnam. And we've seen China have this major push into using the cheaper labor forces in Africa. And so we're seeing supply chains move around the world, but it's interesting to see how flexible some companies are. And one of the interesting ones is you're looking at right now, which is Zoom. So Zoom, being a cloud-based conferencing system, has eclipsed Skype and Teams and many others, because it is, I know RVs, no, there's a question here. Yes, they are buying opportunities, but we're kind of negative right now, Jordan. So it's not a speculative model. I wouldn't say the RV is a speculative model, Jordan. I would say that the RV is designed to for people who have Australian resources and banks, and to complement what you have in Australia with those industries you can't get here. So we want to invest in a smaller pool of assets, because we assume you have Australian assets, and we want to invest in IT, healthcare, consumer products, and those sectors that you can't get locally. Rowan says, the U.S. does not appear to be on top as we are here. Okay, so yeah, now that's a tough one, Rowan. So the U.S. does not appear to be on top of it, and they seem to be the worst in allowing it to spread, and they've got more cases. There are other cases that are coming up that haven't probably been measured as carefully, and the countries like Russia and Brazil are seeing some big increases now. So one of my concerns, and Julie, I'll get to your question in a second, but one of my concerns is that even if the US does go back to work and they start to support the economy with fiscal policy, it may be the weakness in the trading partners which could hold them back. So you need strong partners, and I think in Europe in particular, where you have a centralized bank but decentralized budgets, you could have a very serious problem with their ability to fund the recovery there. So I'm also concerned about trades and issues like that. Now, unpacking comments on supply chain. Can you unpack your comments on supply chain? Okay. With the relative value model, what we've done is split it into 22 different groups of companies by sector. And the first group is going to be raw materials such as metals. And the second is going to be oil. But oil is used as a raw material in plastics. And there are some integrateds, like the big oil companies will have oil and plastics and distribution and pipelines. But it allows us to see what the raw material cost is for chemicals. And similarly, from metals into white goods or cars, you're going to see the cost of steel impacting the earnings from Whirlpool. And it's been a great benefit because you've seen a collapse in the steel price, collapse in the oil price, and you're seeing that flow straight through as a benefit to Whirlpool, who's seeing costs falling faster than demand. So what we've seen is Whirlpool come out with a surprisingly good result, and then you would expect that something similar might apply to Mattel, but then they disappointed. So what we're looking for is the flexibility of each individual company to be able to consume products, manufacture them, and then maintain the market. So the supply chain is really about following that through, not only from oil to plastics to toys, but it might be a build on your computer system. So how are you building out your IT management system, and what components are building on top of each other? Are you going to put in Teams or overlay Microsoft with a Zoom product? So maybe we can talk about that more. Anonymous, the main drivers in adaptability, they're both sector and their company. And within...
You might want to read the question because the audience can't see it.
Right, okay, so what are the main drivers of adaptability at both the sectoral and company level? So, well, it's management. It's management is entering into long-term supply contracts. So if you have an cruise company, for example, like Carnival, who is going to buy their fuel, their diesel, out 18 months, then they're going to have more predictable earnings, but they're also going to have less flexibility. So sometimes there's the need in these companies to hedge out these risks and push your flexibility into a corner. So it's going to be a policy at some companies, and other places it's just the ability to change. It's management's ability to adapt and change as you go. So predominantly the financial debt levels. Well, debt levels are going to create a lot of inflexibility, but remember, whoever's asked that question, that the US consumer has a lot of debt and they're not flexible. And part of the whole US economic system is borrow money to go to college, graduate, no money, you have to get a job. Then borrow money to buy a car, then you have to work, you have to keep working, and then borrow money to buy a house, then you have to keep working, then you borrow money to put the kids through school, and by the time you're 50, you start to pay some of that down, and you're saving for retirement. And so it's a real, the US system of borrowing to keep the economy going puts the US consumer less flexible than many other places. However, the US labor force is also more transportable. So people might go to university in California and take a job in New York, and they will move around more than other places, but I would say that the debt causes the consumer less flexibility. Big US corporations don't carry a lot of debt. In fact, they're mostly positive cash, such as Apple having $100 billion or Cisco. So the debt levels are in the consumer and the government level, which will restrict the government and the consumer. But I would say that US companies are less held back by debt burdens. Okay, let me kind of get through some of the presentation now. I'm going to pause on the question. I'm not going to look at the questions until I get through a couple more slides. So the velocity of creative destruction is fascinating sector by sector. And that was a good question because it was really great what I was leading into is a compression and flexibility of each sector and who has a higher velocity of creative destruction. Now, as we go down from sector into individual stocks, what we're seeing is a blowout in the standard deviation. And so what that means is that to do, anyone done statistics recently, or should I explain this so I can take a breath? Who's done statistics recently can explain what one standard deviation?
Well, the standard deviation describes the variance in expectations for earnings, in this case, about the mean. And the wider the variance, the more uncertainty that reflects in expectations. And stocks with a greater or less certain earnings outcomes will attract a risk discount or command a lower price earnings ratio. And so some of the examples that Joe mentioned prior were companies like Ford with highly variable earnings expectations, in contrast with a consumer products company like Clorox, whose earnings are relatively predictable.
Okay, so Chris, I was actually trying to explain the definition of standard deviation in statistics, which is if you have a bell curve with estimates around it, the distance from the mean is one standard deviation of 66% of the points fall within that range. So one standard deviation is 66% of the data points. Now, I hope I got that kind of close, because some statistics professor would probably give me a C for that explanation.
Well, that's right. So about 68% of a normally distributed probability curve falls within one standard deviation. 95% falls within two standard deviations.
Yeah.
And then you have the outliers.
Yeah, and so that distance reflects the certainty of those predictions. And the lower the standard deviation, the more predictable those earnings are, the higher the price earnings ratio should be. For example, at Clorox, the cleaner company, they have a very narrow, high bell curve. Their earnings estimates for 2021 are 687, and the 68%, or is it 68% of those data points fall within 14 cents either side of that 687 estimate. So that company is currently commanding a price earnings ratio of 28 because they're low risk earnings and they're growing, and there's a big increase in demand for bleach and cleaning products. And snack food company Pepsi also has a low standard deviation, predictable earnings for soft drinks and salty snack food. And so their price earnings ratio is 22. Delta Airlines, on the other hand, we're seeing earnings estimates going down, cut by 34%. To 441, and will continue to fall. But you can see that the standard deviation on the slide here says $1.34, which is a big difference either side of 414. So their forecasted price earnings ratio is risk discounted to 5.8%. And Whirlpool has earnings estimates of 1387 with a standard deviation either side of 1387 of $1.64. And so their price earnings ratio, their standard deviation is lower, and they have a little bit lower than Delta, so they have a little bit higher price earnings ratio. So that's how stocks risks are applied, risk discounts are applied to earnings, but then you get a risk premium for growth. So if you're in the clicks business where you're growing faster than other industries, you might have a higher than average standard deviation around your earnings estimates, but you'll get a bump up for your growth rates. And so the bat fangs are commanding higher growth and higher PE ratios. And right now, Amazon and Alibaba are just killing it. So they're a great place to be. And we have a high exposure to technology with 2 semiconductor stocks and Google and some healthcare. So we're saying Microsoft, for example, and we're talking about standard deviation, velocity of creative destruction here. They said that 2 years of cloud adoption has been accelerated into 2 months. Now, what's really interesting there is their ability to execute. And Amazon Web Services is the leader in cloud services, but Microsoft is playing catch up with a higher growth rate this quarter as they throw that out to their clients at a very rapid pace as people are adopting and moving onto the cloud.
And Joe, I think this speaks to Rowan's question, that the companies that are most adaptable are the ones that have distribution mechanisms that can go digital. Like Microsoft.
Yeah. So and that takes us back to one of the first comments we made, which was that these 5 stocks were 18% of the market in February. Now 20.5, and they continue to grow and do well, while lots of smaller companies are getting even smaller. But we do see a lot of destruction, and I think that the destruction in restaurants, retail, real estate, oil services, airlines, and any people-dense industries. So the last industries that will come back online are where people are closer together. So that would be a music concert, a sporting event, a restaurant, a nightclub, or anywhere where people are close together. That would be transportation, including trams. So how quickly will people get back on trams and be in close quarters? So if you think of turning the economies back on in terms of the people density per meter of an industry, that's going to cause creative destruction, while those industries with people density will come on later and will fail. And that's largely, unfortunately, middle-class families. Going to be, there's so many small businesses out there, whether it's a dry cleaning store down at on the street level, or a restaurant, or any of these services industries. These crowds of people going into these small businesses, these businesses are going to be totally wiped out, and they're going to have to start over from nothing. So there'll be capital destruction. This goes to my argument of an L-shaped recovery in the economy, as opposed to a V-shaped recovery in the stock market. The stock market might have a V recovery because you have a quantitative easing creating liquidity. But in the stock market, if a company has $100 in capital, and during this process, $20 of that capital is wiped out, you don't bounce back and grow from 90, you grow from 80. So the economic recovery is a function of the the reduction in the capital base. And unfortunately, these middle-class families are going to be wiped out. Millions of them. And remember, in the global financial crisis, we had 1 million people lose their homes. And in this case, it's looking like it's going to be much larger than that. Fiscal versus monetary policy. And hopefully I'm going to get on with it. These guys talk some here about individual stocks, but the GDP sank 4.8%. That's only 9 out of 91 days. That did have the impact of China being down for part of the quarter. Estimates are that we're going to see GDP fall, contract between 40 and 65% in the second quarter, and that scares the hell out of me. But these are the range and estimates coming out on Bloomberg from the contributors, which is about 20 contributors into GDP estimates. About 30 out of 165 million people have claimed unemployment. That's 18%. There's 50,000 deaths from the virus. And the New York, if you click through on this, when you get the report, there's a blue highlighted thing there. That tells you some demographics on the deaths. And it says in New York City, or in New York State, 50% of the people who are dying are over 75 years old, 75% are over 65. And I personally had a pretty bad flu last June, so I have some diminished lung capacity. So I would put myself in the risk category, just for disclosure here, of being at risk. And I'm saying let the virus spread. I understand that I'm kind of on the cusp of being just outside of it, but I do have a risk. So I would say my view is let the virus spread. And stop the shutdown. Fiscal and monetary policies are not going to stop a depression. We're headed for a depression. We could have a vaccine in September, but I want to explain a little bit about how vaccines work for those of you who aren't familiar with it. A bacteria is a living thing. A virus is not. It's a parasite. It attaches to a cell and causes that cell to mutate or do whatever. A vaccine takes that virus and it takes the RNA and the DNA out of it, so that it's not dangerous, and then you put that into a body, and the body will create antibodies to attack something that isn't a risk. So the question becomes, will the body get a fever and have a bad reaction to this foreign thing in the body? Now, once you take a vaccine, this guy created a vaccine for smallpox, and then he exposed himself to smallpox and proved that it worked. At Oxford now, there's about 300 to 500 people testing a current vaccine. They're getting fevers, but we're not going to know if it's effective. And then if it does work, does it work temporarily, or do you create enough antibodies to actually cure the virus or prevent the virus, not cure, to prevent the virus. So even if we get a vaccine in September, I don't think that means that everyone's going to take it and nobody's going to get sick. I'll take it, but there are a lot of people who are morally against taking vaccines in the US, and there's a conflict between these parents at school where the parents won't allow their children to take the vaccine, and other parents are saying, then don't take them to school. So there are going to be, it's not going to cure everything with this vaccine, right? You have a question? Yeah, that's a good question. No, no. And so the question is the prospective value in the click stocks priced in? What are the most attractive opportunities currently? Well, we own Google. I'm very, very tempted by Amazon again. I just love what they're doing, and I'm very tempted by Microsoft. But I think we've got a good exposure already to Intel, because Intel is selling what we call, they're the Levi Strauss of the cloud business. In other words, they provide, Levi Strauss sold shovels and pants to miners who were speculators, and they made a lot of money. In this case, the comparison is, say, Intel is selling the chips to all the data centers that are building out cloud solutions. So I like the Intel way of taking a broader exposure to getting into the cloud business. So we did just take a cloud exposure. Intel's doing fine. Qualcomm is our other chip company, and they're the go-to for G5. And the other thing about G5 is it's going to be brought forward. And so we're happy with our exposure. Yes, I love Microsoft. I love Amazon. Very happy with Google. We went in and out of Facebook recently. And so we are generally pretty well exposed to this sector. But we're favoring Google, Qualcomm, and Intel at this stage. All right. Federal monetary policy is not benefiting Main Street. Perversely, it is encouraging the government to borrow money. $4 trillion in quantitative easing is a moral hazard. The Fed has never bought deep into the credit curve before, so they're actually taking risk now. And the problem is that solving liquidity to banks doesn't solve the problem of potential insolvencies. It's the fiscal policy that has to solve potential insolvencies, and $2 trillion doesn't do it. $2 trillion under the Corona Aid Relief Economic Security Act, or CARES Act, says it's $2 trillion, but I'm going to skip a couple of slides here in the details of where that money is going. But it's over 10 years. This $2 trillion is over 10 years, and it is accounting for, if you look at the click-through to the Congressional Budget Office, is accounting for lower GDP and lower tax receipts, as well as some expenditure. So it might sound like 10% of GDP, but over 10 years, that's 1% of GDP. And if you are saying, it really does nothing. So we're really concerned that this is just not meeting what it needs to do. Now, it's going into healthcare, it's going into business relief, it's going into tax credits and unemployment, student loans and IRAs, and it's going into Medicare. Oh, by the way, there's just for it's funny, but it's true, is that there are these new, very popular telehealth companies. And you can have an app on your phone, and you can have a virtual consultation with a doctor. And then you can have the drugs delivered. And ironically, the most popular drug on there is the embarrassing script, Viagra. So it's interesting to see the surge in demand for Viagra. And but the Congressional Budget Office, I'm not getting any. I can't see everyone laughing. So Congressional Budget Office is expecting the CARES Act will increase the federal deficit about $1.8 trillion over 10 years. Oh, that was a ha 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 LOL. Thank you for that. LOL. Okay. So monetary outlays at $1 billion, decrease in revenues about $500 million, and then increase in discretionary outlay about 325. So it's not going to cut it. It's just not going to cut it. So let's get back down into the earnings review now that I've done the macro. What's our time?
41 points.
Oh, we got to power on. Okay. Let me see. Oil, I'm gonna flip through some of this pretty quick. Oil, you're going to see a lot of bankruptcies. Chemicals, severe drop in raw material prices, but they reported very decent earnings. That's going to turn as their demand. So when an oil company has a lower price for their raw material, they're going to, depending on their capacity utilization rate, lower their selling price to reflect the lower raw material price. But if they have tight capacity utilization rates, they can hold on to that benefit a little bit longer. But we expect capacity utilization to drop off, and that lower cost will be passed on in the form of deflation, which is concerning. Packaging is doing really well, surprisingly. The snacks part of the business, if you're buying those Ritz crackers, you're getting packaging. So all of that stuff that's being sold on the in the supermarket shelves is packaged up. And so we're seeing plenty of packaging also where stuff is being shipped through Amazon. So they're seeing lower raw material prices, but continued demand for packaging, which is very interesting. The sector is doing well. Transportation is a total disaster. Many airlines will fail. Manufacturing was initially impacted by Chinese trade, more correlated with US GDP. We could see some velocity creative destruction helping them as they adjusted supply chains in January, but I expect an L-shaped recovery. If there's a destruction in capital from $100 to $50, you're not going to just suddenly start growing from $100 again. You're going to grow from 50. Real estate and construction is just a total disaster. And SL Green, Empire, and Vornado own office buildings in New York. Empire State owns the Empire State Building. SL Green is the largest owner of real estate in New York City, and Vornado is close behind. What we're seeing there is that Vornado, which is really marquee buildings, they're going to have lawyers and accountants and big public companies as tenants. They're still off 10% on their office rents collections in April, but their retail, those restaurants downstairs and the J. Crew and whoever else is going bust, 53% of rents were collected. So these REITs are going to struggle to pay their mortgages and their debt obligations. And SL Green is restructuring their capital to shore up their base, and they're selling some non-core assets. So we're going to see a real problem in real estate. Yeah, I see that in Australia. They're still working. I find that ironic. The only thing I could guess is that there's a whole bunch of unions who say, we're safe and we're going to keep doing things. I don't know why they're still doing it. I see construction workers all over Australia. Maybe it's less dense. Maybe these people are able to keep their meters apart, but I don't know why. And I don't think it's different in the US, Tim. I think it's probably the same. And interestingly, the small business loans were adopted more by small construction companies. And the way I see that small construction company is that they are not capital intensive, they're project intensive and skills intensive. So if somebody's going to do a project, that is financed case by case, and they are not going to see a destruction in capital and a rebuild. They're just going to see a slowdown in business. I don't see it at them as needing the loans as much as companies that have higher fixed costs like restaurants. Autos, deep trouble. Ford is going to lose $5 billion. They borrowed 15, so they have 35 in cash, and that'll hold them through. Steve's friend has an auto dealership. He says he's got pent-up demand in the Midwest, right? Yeah. Significant
Demand. In the Midwest, they reopened car dealerships, and at the beginning of May, and in the first 4 days of the month, they have had record sales. And this is pretty consistent across the industry. This is anecdotal, but it appears that there's a significant pent-up demand for certain products and used cars in particular. So we may see a trend in other industries.
Why don't you continue, Steve?
Okay. Hotels and restaurants, as Joe would say, it's a disaster, and some are not going to survive. What we've seen are a real disparate group. You've got Chipotle, which is trading at a price higher than ever, really, I think, or at least in the last 5 years. And you have Brinker, which is near collapse. So any of these white tablecloth restaurants that aren't open are suffering.
Higher fixed costs.
That's right, higher fixed costs, although they've laid off their workforce. They have rent obligations, which are not currently being paid.
But the gaming companies, so Vegas and Macau, I think they're going to need riot police sooner than anywhere else.
Riot police.
Yeah, oh yeah, there'll be civil disobedience, there'll be looting, there'll be riot police coming in. I was down at Chin Chin's the other day, and these two cops in plainclothes walked in with their bulletproof vests. I mean, they're already visible out there, right?
Yeah, and there are some protests. I'm sure you've seen on the news in the U.S. people who are agitating for a faster reopen. But I think that that's a minority group at the moment. We've got a question here. Is the pent-up demand at normal prices or with deep discounts? Well, okay, so this anecdotal story is at the normal selling price for a used car. They haven't seen a significant reduction in margins.
Yeah, and U.S. home values surprisingly held up this quarter. And there was an article in the Wall Street Journal, and I forget the total argument of why, but housing prices have been retained so far.
And we've seen price inflation in other types of products, particularly digital. And we'll get to that with electronic arts, which is performing very well in this environment. We're just on 13 minutes. I think we'll get to the companies.
Yeah, let's flip through the companies. Food's great.
Yeah, food performing very well. People continue eating, believe it or not, in quarantine.
Well, we're eating differently. So they're not eating at restaurants. They're buying packaged goods at stores. Right? So Costco's killing it.
Or having it delivered.
Yeah.
Yeah. Amazon's delivering groceries from their Whole Foods market, and that has performed very well in the first quarter, or at least the last 3 weeks of the first quarter. Consumer products, again, hygiene products have flown off the shelves. We've seen a shortage in some regions, but it's a very different story with luxury products.
But Steve, I want to say I'm pretty unusual here because I still shave every day, but men aren't shaving.
Have you gotten a haircut recently?
I did get a haircut. Thank you for noticing.
Well, it looks good. I have not. Okay, and in entertainment, I think I'll just flip over to electronic arts. It's up 25% since the end of March. They had very, very good quarterly earnings, and you have to consider that these earnings really picked up steam at the beginning of March, and that drove digital sales. So they beat on a revenue basis, sales of $1.2 billion versus $1.18 billion in estimate. Earnings per share, a fairly significant beat. They guided conservatively for the rest of the year. And the management team is always conservative with their guide. I think they could have probably been a little bit more aggressive. But what we've seen, I mean, this is the perfect example of this shift in consumer behavior, rapid shift toward streaming and digital products. And electronic arts is perfectly positioned to benefit from not only the extra time that people seem to have, but also the way they distribute their products. So they have much higher margins if they're distributing a video game through the internet versus selling a cartridge, which has some, production costs.
Now, Steve, I've covered a lot of the negatives, right? The industries that are collapsing. Now we're getting into the positives. Now we're getting into the companies that are really benefiting from this. So why don't you continue talking about the good news?
That's right. There is good news, but it's very sector specific, and it's primarily technology and firms that have a significant amount of cash that will be able to sustain themselves over this period. Because when the dust settles, there will be some failures, and the companies that remain in sectors that maybe are harder hit right now will benefit with less competition potentially down the track. But this is some time off. We're also going to see a major console refresh cycle in the video game industry in the second half of this year, which should be a tailwind for EA and other game makers. Viacom will report on the 7th, so we don't have
tonight.
So we'll have a research report out tomorrow. Healthcare. Now this is interesting. Very weak, in spite of what was expected, increased demand on hospitals in particular. But what we found in the U.S. is that instead of most hospitals being overwhelmed with COVID patients in almost all parts of the United States, except for New York. Hospitals are underwhelmed. To give an example, the Mayo Clinic, which is in Rochester, Minnesota, has 70% of their hospital beds open right now. And what we've seen is that elective surgery has essentially stopped. Health services for other ailments has essentially stopped. In fact, emergency room visits for other ailments have fallen significantly. So this has hit the healthcare industry hard.
But Medtronic's been okay.
Yeah. I'll hand it to Chris.
To Medtronic. So one of the six of the 8 relative value portfolio holdings reported earnings to date, and Medtronic's one of them. They effectively pre-announced, I should specify, and not really too many surprises. They've experienced a sudden drop in scheduled and emergency medical procedures, and a deferral with larger capex from hospitals, who are obviously distracted at present. But they pointed to and highlighted their strong financial position and their continued investment in R&D and their employees. So they're not making any drastic changes to their long-term growth strategy. They continue to work with regulators on developing new products to build their portfolio of implantable biomedical devices. Speaking to the financial strength, they have about $11 billion in cash and an untapped revolving credit facility of about $3.5 billion. They are an anomaly in that they're a company that has not tapped their revolving credit. So that reassures us. And they also haven't been cutting their investment to preserve cash flow. So it does speak to that strength of the balance sheet. And the challenges that they've experienced do seem very much transient. Following the end of the quarter, they have provided some insight into the weekly revenue figures in different jurisdictions. And while they're about 60% lower than a year ago in North America, and were 50 or 60% lower in China, they're starting to see some stabilization and then improvement. So in China, for example, on a weekly basis, revenues are now down about 20 to 30% versus the prior year. So as we look through this crisis and towards the recovery, looking at countries like China that have been through the COVID economic impact earlier, that's sort of gives us confidence in the outlook for the other geographies.
Chris, 5 minutes.
Okay.
Just go ahead.
Balance sheet. BS is balance sheet, Jim. Thank you. Can we hit the next slide, please?
Use it down now. Just skip that.
All right. Mylan, the generic pharmaceutical business, one of the 2 in the 8 relative value holdings who's yet to report earnings, so that's in about a week's time.
That's Friday.
To computers, this is the sector where the velocity of creativity contrasts with the velocity of destruction in others. So digital services businesses that are able to continue to service work from home and socially isolated consumers and that have good balance sheets are experiencing really an accelerated adoption of their services. The trend, a thematic that was already occurring, has just been accelerated. We covered Microsoft and Amazon Web Services earlier. Perhaps Steve would like to touch on Alphabet.
Yes, very briefly. Maybe in the interest of time, we'll save questions for the end, and if there are some questions, we'll stay a little longer. Alphabet had pretty good results. Revenue growth of 15%, which was above expectations, 41.8 billion. Earnings per share beat estimates. The real strength in this earnings for the quarter was growth in the YouTube division, 33% growth, and 52% growth in the cloud division. And that really carried the company, which saw a 14% decline in ad sales on their traditional Google platform. But again, this is one of the beneficiaries of this COVID environment that we find ourselves in, technology. Semiconductors.
There are no viruses in Taiwan. You know, Taiwan is just clean. I think there's 480 people that got the virus in Taiwan. And that's where most semiconductor manufacturing is. That business is just continuing.
Yes. And if you believe China, there's no viruses there either.
I believe Taiwan more than China.
Yes, of course. They're much more.
So Intel represents as Joe described, a conservative approach to investing in the cloud, whereby it doesn't really matter which business competes or is successful in capturing the market share, because Intel is a supplier to all of those businesses pursuing cloud dominance and benefiting from selling chips to all of them. So profit beat expectations in the first quarter, and when we delve into the composition of the revenue, we're really seeing our investment thesis play out. The data-centric component now represents slightly more than 50%, so it's eclipsing the client computing division, which is the old PC chips, which is in gradual decline, although it did experience a bit of a bump this quarter on that work from home transition. So that was nice to have. But beyond the second quarter guidance, which was unsurprising, Intel's guided for some decline or weakness in government and enterprise spending in the second half of the year, and in an effort to preserve their balance sheet, they've suspended their buybacks.
And just quickly on Qualcomm, great result. They grew by about 7% on a sales basis, 5.2 billion, which beat estimates. On an earnings per share basis, they beat by about 10 cents. This is the story with Qualcomm is all about 5G. And they maintain their 5G handset sales guidance for the rest of the year. So they expect to have their technology in 175 million to 225 million units this year. And on the call, management highlighted the fact that the Chinese handset or mobile device market in China has returned to about the level pre-COVID that they saw. One particular highlight was the increase of 5G handset sales in China. That's accelerating at a faster pace than they had anticipated. So things are back to normal in China, and if that's any indicator of how the rest of the world will follow in the next 6 to 8 to 12 weeks, that's some food for comfort.
Steve, we're no run out of time, but I'm going to make a broad sort of common question here that Disney announced last night they're going to reopen Shanghai, the theme, and in the next few weeks. And Carnival's getting sued for allowing the virus to spread on some ships. And Disney could be very exposed. So is China lying about the number of cases?
Oh, I think
if Disney's going to come out and Disney's going to put their legal team in jeopardy. I don't get this. China is lying about the number of cases thing.
I just think the numbers are hard to believe, given China's population. It's hard to believe that today they had 2 new cases. That just doesn't comport.
Yeah, there's a big question here, and that's uncertain. Let's move on.
But we know we can't trust China on a number of levels, and they were very reluctant to share information with the world early on when this crisis was developing.
But isn't that Trump just screwing it up himself and trying to blame somebody else?
Yeah, I think there's some element of Trump.
We have rigorous debates here. Let's finish the presentation.
Okay, so one interesting element of these earnings is that the 5G sales for Qualcomm, so the technology that they put into all 5G devices, they get a royalty on. They make about 50% more money on 5G devices versus 4G. So this is just going to accelerate sales growth for the next 5 years, really. I think we're. How are we going to talk?
Let's just finish by saying Goldman Sachs is killing it.
Okay,
so
maybe
Goldman Sachs. Chris, you just say Goldman Sachs trading business is killing it from all this quantitative easing, right?
We might go a minute or two over. Yes, so generally the bank's results were characterised by increases in provisions for debt, expected defaults, not only at a mortgage level for retail, but also sectors that have been most hard hit by the social isolation policies, as well as the energy sector, which is not getting as much media attention as perhaps it should, but that's a significant impact on a sector of the economy which is pretty significantly indebted. Goldman Sachs had a really good, clean result, revenue marginally down, and per share earnings missed expectations. The three real significant sectors of the business all experienced north of 20% revenue growth, with the trading division the absolute highlight. Fixed income and equities trading revenue in the quarter was the best and the second best in the last 5 years. And they took some investment losses in their asset management division, which are likely to reverse in quarters that follow as asset prices recover. If we look to Goldman Sachs's sensitivity to lending and compare that to some of their peers, we see that Goldman Sachs's income fell 46% for the quarter. JP Morgan's down 69%, Wells Fargo down 89%, and really that speaks to the exposure to net interest income, or how much they rely on interest as a source of revenue. It's about 12% at Goldman Sachs, half of revenue at JP Morgan, and 57% at Wells Fargo. So Goldman Sachs have really demonstrated the benefits of being well diversified, and that is something that actively sought to achieve over the last few years, smoothing the boom and bust sort of cyclical or volatile nature of their revenue and profitability. So they've had some success to date. At 76% of book value, looks like a very good value to us. So in conclusion, the relative value model currently comprises 8 stocks and 2 portions cash. And we've got, of course, the supplementary BATS basket of Chinese growth stocks.
And if there are any questions, we'll stick around.
Yes, we'll stick around for questions.
Thank you.
Thank you, Chris. A replay of today's webcast will be made available shortly after the conclusion of this event and will be emailed to you. A copy of the relative value model report will also be emailed later this afternoon. Listeners with additional questions can contact myself or the team by phone or email as per the contact information available on the website. And that does conclude today's webcast. Thank you all for joining us. We appreciate your time. Stay safe, everybody, and we look forward to speaking with you again. You may now disconnect.
Thank you.
Thank you.
Yeah.